Rebecca, thank you for joining us here Friday morning post JP Morgan. Excited to dig in on experience at the conference, things you were hearing, and also how it relates to 2026 outlook that y'all are thinking about in terms of middle market activity. What's going on there? How were you spending your time during the couple of days? Where were insights coming from in your time during the week?
So, with Bailey and Company, we're a healthcare investment bank. So we really spend our time at a conference like JP Morgan meeting with companies that are current or prospective clients, meeting with consultants and other folks in the industry, trading notes on what's going on, uh, helping to introduce companies to private equity investors. We'll hold what's called fireside chats. There's no fireplace involved in this, but it does involve usually being in a hotel room, allowing a management team to kind of give an early overview and look at a company to prospective investors. And then we'll take meetings with private equity firms that we maintain relationships with and talk about things like what's coming up in the deal pipeline for 2026. All this is done in, as mentioned, converted hotel rooms and steakhouses, primarily
And
throughout Union Square.
can you give us a little sense for what deal making looked like last year and the outlook going into this year to give us a framing for what this conference felt like?
So rewind back to JP Morgan 2025, and the interesting thing about this conference from my perspective is that it is the event at the beginning of the year where the healthcare finance industry comes together and says what's coming next and kind of takes a pulse check, right? So JP Morgan 2025, there was a large amount of optimism for the year ahead and expectations, grounded in data or not, that there was going to be a resurgence in deal activity. There's a lot of dry powder sitting around. We have a new Republican administration. It's time to get things done. That really didn't pan out. There were macro shocks. If you think back to early in the year, tariff policy, the negotiation of the One Big Beautiful Bill Act, which stretched from kind of spring all the way through until the fall. And so we saw things be pretty quiet through the middle of the year and then start to pick up in Q3. General pulse, and this is was pretty universal in our conversations at the conference this year, JP Morgan 2026, was, cautiously optimistic, but a lot of folks kind of remember the false start that we had a year ago and don't want to get ahead of their skis. So I was in a lot of conversations where, private equity firms were saying, seems like we're going to have a good year. We're busy. Pipeline looks pretty good. I don't really know. We'll see what happens. What's in your pipeline? Like, let's go. There's a sort of like, I'm done trying to predict the future. Let's just try to get things done right now, which is probably healthy for the industry.
Did you get a sense of when we'll start to know better? Like, what will be the indicators of how the year is starting to pan out?
The next check-in point is the HP Miami conference. That's just as big an event for the private equity healthcare and M&A industry. You sort of hear about processes getting ready to launch at JP Morgan, and then you see if they actually came to market in March when HP Miami hits, and that tends to be the kind of litmus test for what kind of year we're going to have, at least in the first half.
One of the topics we think most about in early stage healthcare community, and we certainly heard a lot about in the private company tracks this week, was AI adoption, both the future big potential for AI adoption and also practical, more near term use cases. One of the things that stood out to me most was hearing Point Click Care say they think they're going to provide as much value to their clients over the next 2 years as they have in the last 30, which was pretty eye opening for me to hear. I'd be curious how private equity community is viewing AI and what you're hearing in terms of how that's impacting that market and flowing through there.
Yeah, that's interesting from PCC, a kind of traditional dominant practice management platform, and I wonder if that's generalizable to some of the other sort of vertical leaders. I asked this AI question in a lot of meetings out in San Francisco and got two answers. The first answer tends to come from services focused investors, more traditional private equity investors. And they see AI as something that can incrementally help them improve margin for manual workflows in their portfolio companies. Revenue cycle management is a great example of that. There are lots of levers that can be pulled. AI becomes an extension of an existing investment thesis, which is let's take what's effectively a body shop and tech enable it and make it more efficient and get margin improvement in a revenue cycle management company. That's sort of thesis number one. There's not a huge amount of concern about disruption among that group of investors. The thinking is, you know, healthcare moves slowly. There are enough specialized, relationship driven, manual friction points in these processes that you're not going to sort of wipe out the entire business model with AI. You're just going to improve it and make it more efficient. Bucket number two is more technology focused investors who are feeling some AI fatigue and are pulling back from software a little bit as a result. They've seen very high valuations over the past couple of years. They are realizing that AI in some ways can commoditize software development because it makes coding so much more faster and more efficient. And they're wondering how can you with something that's moving this quickly in terms of AI development, how can you really diligence disruption risk over a 5-year hold period and then intend to sell your company to someone else who's going to be diligencing over a 5-year period? So you really have to be able to look 10 years out when you're making the investment today. And we've just seen so much rapid change. So there is a movement among some of the more technology focused firms to actually pull back and look at tech enabled services business models out of concern around AI.
Rebecca, one of the observations from sitting through, I mean, there are a handful of rev cycle presentations in the private company track,
Mm.
and they're all finding dollars for health systems, right? Using AI to go deeper into contracts, find opportunities. So CMS leadership spoke on Tuesday. They gave a keynote at the conference, and they spoke about how in the risk adjustment space, they think it's been a mistake that that's become a competitive advantage for some insurers. That risk adjustment should be about leveling the playing field. When you've got thicker patients, you get paid more for them. When you have healthier patients, you get paid less for them. It should be nobody's competitive advantage that you're better at risk adjustment. I say that because one of the themes that came up in a few presentations, Ensemble is a good example. Rev cycle fundamentally is the byproduct of the friction between payers and providers, right? And in many ways, to me, um, what started going through my head is that the opportunity in rev cycle feels like the provider side of what the opportunity was for payers with risk adjustment in the 2015 to 2020 era, where there's essentially a new pot of money that was discovered and a lot of activity to go after that money by the incumbents and willingness to bring startups in and growth in the startup community as a result of that. Consequently, it feels like the space is overheating to me and is not going to, like, there's going to be, if I play out the risk adjustment cycle as it relates to RCM over the coming years, and I don't know the exact timeline of this, but it feels like there's going to be a few entrepreneurial successes, a few companies that do really well. That is largely going to be a question of how you time the market to make sure that you are exiting at the right point in time. And then there's going to be a contraction when inevitably that pot of money gets pulled back over time. It is one of my like growing thoughts coming out of the week, but it was notable to me kind of that energy across the RCM presentations.
So why is rev cycle overheating on the VC side of things? It definitely seems like it is. I maybe have a more simplistic explanation for this, and push back if you think this is wrong. But you know, I think you see in public markets the valuation that's being put on AI opportunity, and you have VCs looking at healthcare and saying, "Well, that opportunity must exist somewhere in healthcare. Where does it exist? Where can I put that AI opportunity into an investment?" Um, they've sort of landed. Well, first they landed on AI scribing. That was the most obvious place to go. And now number two, it's provider operations and revenue cycle, which is, becomes, especially the front end of revenue cycle, becomes sort of directly adjacent to AI scribing. It's maybe a little bit misplaced because I think in order to justify those valuations, you would need to envision AI completely disrupting the workflow end to end, right? The revenue cycle workflow has so many friction points built into it. You still have to fax the prior authorization to the payer in many cases, right? There's some progress there. I think Epic Payer
Okay.
Platform is a key, but that adoption is taking a long time. It's really expensive. Payers move slowly. There's the data and uh, sort of payer provider communication exchange cycle is so fragmented that I don't think you can have any technology that sort of solves the whole problem quickly. You're going to have technologies that solve little pockets of it. So that's piece number one. And I'd be curious to get your take, but you can make coding really efficient, but you're not going to be able to extend along the workflow with that same technology because there's a breakpoint in terms of the data and communications that you need between payer and provider on either side of that workflow.
I very much agree with the issues with kind of the point solution approach coming in. It feels like there are a handful of entities that are trying to smarter technology is example of this. They are trying to make the case that we are going to be that end-to-end platform. We've stitched together some assets to do it. And part of the pitch is these institutions are burnt out of the pitches from Y Combinator companies coming to them
Hmm.
pitching one individual point of that. And they're moving on from that to a holistic end-to-end partner, whether that's smarter technologies going after that or Ensemble, which is very much less AI specific and much more, end-to-end rev cycle partner. To me, so smarter is a good example of this. A core part of their pitch is, hey, we've got a system in the Mid Atlantic that's seeing $9 million a month in increased revenue that they weren't seeing before, and that to me is the part that's hard to. It's hard to wrap my head around, right? It's the underlying friction point that doesn't get solved
Hmm.
here by these
Hmm.
platforms. And so the pot of money, that's where it feels like we're seeing this spike in health systems going after that mid-Atlantic system and smarter that's saying, hey, we're going to see $9 million of uptick. Great. Get us back to improve our margins for a period of time. In my mind, that's going to be eroded pretty quick as payers come back to the table in negotiations and we go around and around.
You're hitting on the point that folks forget sometimes when they're talking about revenue cycle, which is that the payers have access to the same the same technology and are doing the
Right.
same thing, right? And if you think about
Right.
the payment integrity life cycle, you have, fraud, waste, abuse, credentialing, exclusion monitoring. So, should this provider be getting paid in the first place? Then you have prepay claim edits. Then you have
Mhm.
utilization management. Then you have post-pay claim edits. Then you have subrogation where you're pushing that claim to another payer a year or two after it's already been paid out. I mean, this is a long and complex cycle.
Sure.
And, folks focus on the, prior auth adjudication as the one kind of, touch point. And should AI be doing that? Of course, it shouldn't be directly. It can gather up data and sort of serve it up for a human reviewer. But every stage in
Yeah.
that life cycle has automation opportunities, and then a parallel on the provider side where you sort of watch the payer's behavior and as you're saying, predict where denials are going to come from. So I don't think we get to the dystopian, payer provider bots warring against each other anytime soon. Again, there's too many manual friction points in that workflow for that to really happen. But I do think you see a bit of an arms race on both sides of the revenue cycle over the coming years.
One of the things I was most intrigued by in what you shared with us in advance of conversation about takeaways was the activity and longevity market, which surprised me a little bit. I don't necessarily think of private equity being active in longevity market, concierge market. What's the conversation like in private equity landscape? How do you think that evolves in 2026 and where do you see activity there?
Yeah, I think it's early days, but I do see a number of signs that this is emerging as a key investment theme. I think you'll see private equity firms work up a thesis in this space and begin to make early bets in 2026. And there are a couple of deals in market or close to closing or close to coming to market that we know of. And then, things build over time, right? So it may be, another year or two before we get to a place of kind of widespread investment in the sector, predicting a little far out there, but I do think this is coming. There are a number of attractive characteristics of the sector for private equity, the most obvious of which is that it's cash pay, and so you don't have reimbursement risk. That's always a win. And then you start to think about, you know, private equity healthcare portfolios, for good reason, index heavily on the demographic trend of aging population, chronic conditions, high acuity care, right? That's where the dollars come from in most healthcare provider investments. There's a separate and increasingly powerful trend of younger generations investing in health and wellness, viewing that as a consumption category, being more conscious about their health, and taking a more consumer approach to interacting with the healthcare system, be it traditional or non-traditional. And so from a portfolio construction perspective, I think you'll see folks start to want to balance those two trends as the latter continues to emerge.
The conversation in the US right now is very much around the price sensitivity of the American consumer for healthcare costs. Obviously, there's some regulatory stuff going on with the ACA marketplace. The other piece of it is employers are continuing to feel it. But I'm curious what themes you're seeing emerge in that category when it comes to cost containment for employers.
From an investment perspective, I'd say employer funded healthcare was probably the hottest theme of 2025. Will probably continue to be at least in 2026. There are a number of large deals that will be in market and, plenty of smaller ones as well. Continued cost increases above the rate of inflation for employers. If you start to look at things like pharmacy or stop loss, which is essential for self-funding in many cases, you see double-digit increases year over year for the past several years. So this is really unsustainable. Um, there are a number of different ways to play the space, all of which are attractive to investors at this point. But a couple of things we're watching. Continue to see a lot of interest in independent TPAs. There aren't many of those of scale left. Every time one comes to market, the market gets really excited about it. See very high multiples there. Um, some diversified cost containment platforms that have stitched together everything from specialty pharmacy solutions to care navigation to payment integrity solutions and everything in between. Chronic condition programs, right? Sort of have a one-stop shop for employers that are self-insuring. And then we see a growing interest in alternative plan designs, whether that is MEC and MVP plans, right? What are the low-cost alternatives to sort of traditional PPO style insurance? Whether that's direct primary care in combination with, I don't know, like a voluntary benefit plan design, critical illness, hospital indemnity. You could sort of stitch together something that isn't full major medical coverage, but it's better than nothing, depending on the employer profile. And then, of course, my favorite topic, we continue to see ICHRA adoption be very, very strong, despite all of the noise in the ACA. Market probably doubled at least over this OEP, and certainly investors taking note of that as well.
That's sort of shocking to me that it doubled because this is like the worst year to be switching over from a employer plan, not from a finance perspective, but just from a change management perspective. It just feels like all of the messaging around sending your employees out to the marketplace it's scary out there.
Yeah, I mean, um, there's a little bit of a gap between the headlines and the reality, in terms of what the ICHRA companies, saw on their book of business. One point to make is that, you see the overall price increase numbers per state, and I don't know, the average is somewhere in the low mid-20s, I think. If you look on a county by county basis, that actually varies considerably. Some counties are down, a few will spike up. That gets averaged across the state. But in ICHRA, if you have the right tooling, you can actually rate by zip code. And so you can control a lot of the cost increase that way. So there are very nuanced mechanisms that can allow costs to stay under control. Two, the picture is no better on the small group side or the stop loss side of things, right? Um, and if you chart out, change in cost of healthcare for fully insured versus ACA over the past, pick any time horizon, 5 years or whatever, it's a huge gap, right? And ACA takes up a little bit this year, but is still more cost effective in many cases. There's probably a little bit more churn in the ICHRA market over this OEP than we saw last year, largely in states that saw big increases for very cost sensitive employers may have flipped back to fully insured RBP or level funded. But in general, again, really strong adoption.
Medicaid's been a very hot topic on the regulatory space and also in the VC world because there's a lot of big changes coming to Medicaid, mostly a lot of money getting pulled out, but also this bolus of money from the Rural Health Transformation Program. From your perspective at the conference, what were the conversations around Medicaid and rural?
From an investor perspective, there are two types of investors with reference to Medicaid: investors who are comfortable with Medicaid, and investors who aren't, and that's kind of set at this point. The number of investors in the comfortable category is actually higher than you would think. Plenty of firms have experience investing in, personal care or autism therapy, and have sort of gotten comfortable with the fact that, okay, you just need to work state by state, look at each individual market, and do your homework on the policy landscape, and you can kind of pick your spots. So we still saw Medicaid deals get done in 2025, and I think we will continue to do so. Two trends that I'm watching in Medicaid. One is what you bring up, sort of rural health um, piece. There is a feeling that the at the federal and state level, the need to invest in rural health care is real, and dollars will continue to flow there. And so you have folks looking specifically to make a bet. It's kind of a niche, but it's seen as a good place to invest. Number two, the conversation around Medicaid risk is increasingly focusing on increased payment integrity and utilization management on the payer side as opposed to rate changes. That is seen as the bigger risk as there is a growing emphasis, particularly among conservative lawmakers and some of the conservative think tanks, on fraud, waste, and abuse in Medicare. And we're seeing the payers get aggressive in specific categories on denying prior authorizations, limiting therapy hours in categories like autism therapy and that sort of thing.
Rebecca, I'd be curious to hear the latest on private equity fund strategies. You mentioned a little bit about how they're thinking about check sizes, how they're thinking about deal flow activity. How do you see that evolving over 2026? What do you think is interesting happening in that part of private equity world?
Yeah, it's interesting. We've sort of run the numbers on what funds have been raised. Based on fund size, you can kind of generalize to check size that they want to write relative to the size of assets that exist in the market and are likely to come to market. And there's this structural imbalance in private equity land where there's a lack of relative to demand of assets in the 200 to 500 enterprise value range. And then as you go up and down from that, the sort of demand supply ratio kind of evens out a little bit. But also a lack of demand in sort of 50 to 200, but it's most acute at the top end of that range. What does that mean? It means that a bunch of private equity firms have been sitting on dry powder. Deal flow has been slower over the past couple of years. They're sort of behind on deploying capital in many cases. So we see, as a result, when something attractive comes to market in a target sector, like something in employer health or certain areas of healthcare technology, pharma services, very aggressive behavior, and we see high multiples as a result. We also see firms adapting their capital deployment strategies to try to get access to more deal flow. So many firms, as they as they raise successive funds, right, they tend to raise larger and larger funds. They move up market. That's seen as a sign of progress and success. Great. Well, it means you sort of price yourself out of the smaller deals that you used to do. And there's a lot of deal flow at the lower end of the market, and that's volume that you're missing. And it might be volume that's in a thematic area that you feel high conviction about. So we see funds, um, raising new vehicles so that they have a sort of small cap fund so they can go after those smaller deals. We see them carving out sort of a sleeve within a larger fund and saying, hey, this is going to be for our $10 million checks or whatever. Or we're going to do a couple deals out of this fund, prove out the thesis, and then raise a new small cap fund. So all of that is happening. The other trend that I would call out is that I think we're increasingly seeing a meeting of the minds between VC investors that have companies in their portfolios, healthcare technology companies that, I don't know, got to like 10, 15, 20 million in revenue, aren't going to be the next IPO, are perfectly good companies, but kind of need some scale and are at larger point solution stage. And the VC fund needs an exit, and private equity investors who are willing to write that check. So I think you see this in the data, and we're going to continue to see it, a little bit more of the VC to private equity transaction. And often those can be done on a revenue multiple. And we're seeing firms that would traditionally buy on an EBITDA multiple, more established, profitable companies, for certain themes, be willing to look at, a sort of break even or slightly profitable company that's coming out of the VC world, as long as the valuation's in the right place.
I would assume that's part of a traditional kind of PE roll-up strategy of those point solutions into broader platform offering that they're going to take to market and scale.
It can be either, adding that company onto an existing larger platform, or it can be a platform investment with a view toward doing M&A. And another thing that we're hearing is that some of the VC-backed founders that have gotten to that
Mhm.
stage are looking around. They see subscale competitors that, maybe have 5 million of revenue or whatever, that they'd like to acquire. And
Yeah.
they can be supported to do that better within a private equity portfolio, so they're interested in that transaction.
It's been interesting to see New Mountain has kind of stood out over the past
Mhm.
couple of years with their ability, willingness to apply that mindset that it sounds like you're talking about, right? Like look at it from a revenue multiple, grow into profits over time, stitch together some traditional VC-esque assets. So it'd be interesting to see more of that.
Yeah. Yeah, that's a great example, and, yeah, certainly other firms
Yeah.
pursuing similar strategy.
This has been fun. I appreciate the time, Rebecca. It's always fun hearing your perspective on the world. It's always fun to hear kind of the similar yet adjacent worlds that private equity VC occupy and how we process them differently. So appreciate you hopping on, and always fun catching up.
Yeah, this was great. Thanks for having me.
This podcast was recorded and is for informational purposes only. By accessing this podcast, you acknowledge that Bailey and Company makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information provided. The views, information, or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily reflect those of Bailey and Company. This podcast should not be used as a substitute for competent investment advice from a licensed professional in your state and should not be construed as an offer to make or consider any investment or course of action.